Hello everybody again. It's a pleasure to be with you, Pedro and Joy today.
Pleasure to be here.
So today we're going to discuss a little bit about how to get investment, international investment for startups. So before we start, can you just briefly describe what you do? You just gave a presentation, but really quick in your organizations.
Sure. I think I just spoke, so if you want to go ahead, please.
So I work for TECHCRUNCH, so I run the event side of our business. I work on building new products and also sort of the roadmap for what we're going to do next. So I'm part of the strategic team as well.
Cool. Well, I'm also based in San Francisco and run a seed stage fund, a $20 million fund, investing in the US and selectively in Brazil. $250K to $1 million checks.
Great, thank you. So let's get started this panel with, I'm really curious to hear your thoughts on what's the current state of the international capital in terms of venture investing. What's your view? Like what are the global trends? What is happening? What are the most interesting regions to invest?
Well, from my point of view, the venture capital world has two big poles. One is in the US and one is in China. And then here in Latin America, Brazil is really the center of gravity, as well as Mexico City and Mexico. So I think it's really important to seek investment from the two largest venture capital markets in the world, both the US and China. And when I say China, I really mean Beijing, and when I say the US, I mean San Francisco, because those are the two most important places where money's flowing.
Yeah, well, I think that one of the slides I was mentioning was just about where the total value per investment returns-wise, like how that has been distributed across the world, and it used to be mostly the US and mostly California, and now China plays a big role into that, and then emerging markets as a whole also play a big role in that. So and because we're in Brazil, so we can talk about that specifically, it's for the first time ever that we actually have high quality companies at every stage of the venture capital funnel within technology. So we've had 3 IPOs and 4 unicorns just in the past year in Brazil. Sure, that's smaller in comparison to the US or the Chinese market, but we've never had a steady flow of high-value companies where everyone involved within the chain of financing is actually making money, and this is the first time ever. So there are a lot of people now closing Series Cs and Series Ds in Brazil, and that was not the case in the past. And then I absolutely agree with you that when you're thinking about a financing strategy for your company, you want to have a best-in-class hybrid approach, where you're raising money from phenomenal local investors that do have the connection, right, in the US. Because what happens is that there's not enough capital locally to fund some of these businesses, or when you do find that capital, it's typically with more onerous terms. So the best way to raise money in general for anything is to just build a very competitive process where you sell people on fear, specifically the fear of missing out. And you can only do that when you have a good company and you approach 40, 50, 60 funds at the same time. There aren't that many funds in emerging markets when you can have that balanced funnel. So that hybrid strategy is very important. And then the last point is just really understanding what is it that the VCs in the Valley, for instance, are buying when it comes to emerging markets investing. And I'll tell you that, like, I don't think that there is to date a very sophisticated strategy to invest in emerging markets. Literally, there isn't,
not.
Right? There's not.
I mean, TECHCRUNCH is going into these emerging markets. Like, we were in Kenya, we were in Lebanon last week, or not last week, last month. We're going to Nigeria later this year. And there's like, I mean, we see some of the larger firms will come with us, but these are first looks for a lot of these big funds. Or they're 12 months into a strategy there. It's like, they don't have a specific, they're not looking at sectors, they're just like, I mean, yeah.
I'll share an example. So for instance, I know that you've had one of our companies at your event, the Battlefield yesterday, was Rappi.
Right.
So it was the first check from Silicon Valley in Rappi. I sourced that deal, and we introduced them to 45 funds in 2 weeks, and then it took Andreessen and Foundation and Floodgate and a few others 2.5 weeks to 3 weeks to understand it. Where
Yeah.
we were like, we met with the founders in 10 minutes, we were like, boom, we got to do this. So there has been a shift in mentality, but they are also incredible founders, very good salespeople. They had the numbers. So there isn't a consistent strategy. They were the very first deal that Andreessen Horowitz did in Latin America. And I think that it was, I think it was because Jeff Jordan, the former CEO of OpenTable, was just fascinated by the quality of the founders and the market that they were going after. But these large firms really don't, it wasn't clear, right? Like that, if you ask me, we weren't the ones that introduced them to Andreessen, like, oh, should we introduce to them? And I'll be like, no, they're just at, the Sand Hill Road, Rosewood Hotel type of stuff. Like they're not interested in Brazil. But it turns out that after that, we invested with them again in another marketplace and another one. So it has changed, but I'll give you an example. We just had the elections here, and I saw all the international media talking about the fact that as if we were electing the next Hitler. And it was not the case. I'm not defending anyone politically, but the problem, though, is that, we have so much confirmation biases, and you don't invest in things that you don't understand.
Right. Well, and there's also a huge amount of deal flow in market in the U.S., right? Like, if you're in San Francisco or you're in Palo Alto or whatever, you really don't have to leave, Sand Hill Road. All the deals come to you because that's what happens when you're the epicenter of capital like that. Same in Beijing, right? Like, everybody from Southeast Asia flies to Beijing. So what happens is nobody invents a strategy because they don't have to. Now, there are funds like GGV. Hans Tung was here yesterday, right?
Yeah.
He has an international strategy. He goes to China 7 times a year. He came here, right, to check out what's going on. So there are a few firms that are seeking some sort of competitive advantage by coming to these markets. There's another Founders Factory / Founders Fund out of the UK. Are you familiar with Brent Hoberman?
No.
So they actually have a strategy where they're deploying teams down to like Lagos and Nairobi and places like that. I don't know if they've done anything here, but they're also very sophisticated in the UK. So it's happening, but they're with very niche firms, with people where there's just an interest at the partner level to do that, to develop a strategy and approach. That's what I've seen. I mean, but I think the real problem is like these guys in these big places that are deep, all the companies just come to them and they don't have to invent a strategy.
That's totally true. I think you're right. And I've seen things all the way from like, why did you invest in Brazil? And I started dating a Brazilian. I'm not joking. This is like a true story. All the way towards like, hey, we actually have a very serious thesis behind emerging markets, and we think that fintech is the only play that we're going to do within this market. So there's no consistency, but more and more new funds have been raised to fund companies in emerging markets. But my main concern as someone that does, both, because we invest also in things that are just in the U.S., is that when we're investing in a founder in an emerging market, I'm always thinking, okay, a year from now, will someone that has never traveled to that country or solved that problem be able to clearly understand this?
So here's a really interesting example. I don't remember the name of the company, but we had a company from Africa come to San Francisco and compete in our startup competition that it was like the one we held yesterday. And the product was awesome. They won the Battlefield. And typically, when you win the Battlefield competition in San Francisco, there's a term sheet waiting for you on the other side. Well, this company, that didn't happen for them. And it's because all the VCs are like, we don't, it's a cool product, but we don't understand why people should use it or why it's valuable. They just didn't get it. And it was basically, if I remember correctly, it was basically a peer-to-peer money sharing technology that operated. And but everybody's like, why would you need that? Like, because everybody in the US is banked and everybody in Europe is banked, and like, just didn't get it. And so it's like what normally would happen just didn't happen in that instance.
So Joe, in that sense, and Pedro, what would you say that founders have to do in order to, once they have a product like that one, which might not be something familiar for let's say a US-based fund, what do they have to do to become appealing for those funds? You were talking, Pedro, before about, partnering up with a local VC fund that might take them to the next level of funding. But what other things do you think are important for these entrepreneurs to start doing in terms of attracting the attention of these international VC funds?
I think focus first on a very large market, be an excellent communicator, and if you can convince a few local players to also invest in you, it's better because it gives them credibility, right? There have been now firms that are in Latin America or Africa and India, they're raising their third, their fourth fund. And in our business, we usually say that the first fund you raise on promise, the second in momentum, the third on metrics. So anyone that has a fund 4 has done a good job, which means that they're there to stay. So I'd say that the VCs in the US do care about who else you're raising money from. So those, at least this is based upon my experience, having invested, we've done deals already with DST, Sequoia, Andreessen, NEA, and all the local funds in Brazil.
So you think the best way to access international capital is to do your pre-seed, seed, Series A, Series B, develop a product, go to market, and then just take it into a larger market and say, look, we have a viable product and we have an audience for this product?
I think that there is appetite, for instance, for even the international funds to invest at the seed level in international companies. But usually when that happens, they've been through Y Combinator, for instance, right? You need that extra layer of validation. And these jumbo funds, they really don't care if they're paying a $5 million to a $10, $15 million valuation. For us, it changes dramatically.
Right.
Like a post-demo day YC company is a much more expensive company. But they need some sort of external validation, I think, just to wash out some of their potential biases. And this is just a human thing. It's not even a criticism.
Right.
Yeah, I mean, they were not familiar to those for a company going to YC and eventually asking for funding, there is this seal of approval, which will make it easier for them. So your piece of advice would be to either look for a local fund to get them connected with these other funds, or look for something like a YC type of.
Preferably both, and I've seen the strategy that works the best is both. And the third thing is also don't be afraid of being of going cold. Like that whole thing about, I don't understand, this is the only industry people say you can only talk to us when there's like a warm intro or a referral. I think this is a lie. If I receive a very good cold email, I will respond. The problem is that 90% of cold emails are shitty. People write fucking Bibles, they don't have context, it's uninteresting. But even Rappi was a good example. They cold email Alfred Lin because Sebas, that was in the keynote, saw that he was on first class at one flight, and then cold email him, and then as soon as the plane landed, he rushed to shake his hand, and then Sequoia led their $43 million Series A. So it's we're in business to do good business. The problem, again, it goes back to communication. Founders sometimes just don't. You have to be an excellent communicator. It's a trait that we look for the most because we invest mostly in foreign founders.
Anything else to elaborate on that point?
No.
So you were talking a little bit about investing in industries like fintech, or Rappi. I mean, they're doing delivery services on demand. What other industries or verticals do you think are going to be the next thing to invest? Not just in Latin America, but you were talking about markets like the US and China.
For TECHCRUNCH, the things that we're focused on right now, AI and robotics are really huge for us. Blockchain is huge, not necessarily crypto. I mean, that whole world is, you could argue that it's falling apart right now. It's really hard to tell, but we, blockchain as a technology, an enabler, we believe in, and mobility. Mobility used to be a very thin category, but it's it's one of the broadest categories, but I think there's a lot of momentum in a lot of different components of mobility right now. So those are things that we're focused on at TECHCRUNCH, and I think that are, we are in San Francisco and we're, hosting events and writing about those things. I mean, e-commerce is also super interesting, and e-commerce is interesting because of all the technology, last mile technologies, and transactions have gotten easier and all sorts of stuff like that. So from a media perspective, and obviously I'm a firm believer that the investment industry and the media are connected in a sort of cyclic way. That's what we're interested in. I don't know. What do you think?
Well, I think in emerging, the view is a little different for emerging markets versus the US. So the fund I used to work before, Funders Club, so we seeded Coinbase, we seeded Shapeshift, Protocol Labs, a bunch of businesses that today are worth hundreds of millions or billions of dollars in crypto 5 years ago, when none of it made sense. When and so I still think that crypto has massive potential because you haven't had institutional investors, really, really large, big people coming in and making investments. Now you're starting to have insurance, custodian services. The SEC hasn't approved an ETF yet, so there's still a lot of room for growth there. I am a big fan of developer tools, and it goes again because of my background. I was one of the first, I was employee number 11 at this company called SendGrid, that was recently acquired and went public. So I like developer tools, and I mean B2B software at large, and anything that has to deal with open protocols. It goes again with the tokenization of the world with crypto, but open protocols are fascinating because we still use a lot of email. It's because the SMTP protocol, you have Hotmail, I have Gmail, but we can communicate. And then the web, after Google, started to be really closed because of mobile ecosystems and Facebook, and they're all closed platforms. And now with the decentralization of assets because of the blockchain, you're going to have a whole new flux of open applications, again, built on protocols that can exchange information across different systems. So at a high level, that's one of the things that I'm the most, I'm fascinated by, because it applies to every single industry, from you being trying to open up the garage of your building, to subscribing to an article, to buying something. In emerging markets, we have a very laser-focused thesis. So we would never invest. Actually, let me rephrase, because probably on the record. So we prefer not to invest right now in things that are the Zendesk for Brazil, or the HubSpot for, that doesn't make sense to us, because that is, you're playing a currency hedging game. It could be the case, for instance, I think Tiger Global, I think that they invested in Decolar.com, Descargar.com. Sequoia-backed company went public. Because of the currency crisis in the past 5-6 years in Latin America as a whole, I don't think that they've made the returns that they were expecting. But the company grew 5-10x. But if the currency devaluates, it's complicated. We're not going to have a shortage of corrupt politicians or complicated systems in Latin America. So that's where we're interested in. So, for instance, in Brazil, I don't know if you guys know, but we have these things because of the way that we were colonized by the Portuguese, called cartórios. It's basically notary houses, right? And they're all over the country. And the reason why is because there's just so much fraud in the society that it's, the best way of defining a cartório is an offline blockchain network of physical houses. Whenever you sell your car or you do something, some person has to see if you are you, and you sign in front of them.
We have the same in Mexico, by the way.
You have the same in Mexico, exactly.
Yeah.
There you go. So we've invested in the largest notary house in Brazil that it doesn't operate a single notary house. It's like the Airbnb or the Instacart for that. That's an $83 billion a year market. And every large corporation has dedicated departments just to figure this shit out. You want to transport oil and gas? You want to build a building? You want to buy or sell something? You have to have these people within your organization. So we basically, there's this fruit, right, in Brazil called jabuticaba. So we call that, it's only here, so we call that investing in jabuticabas on steroids, basically. So it's satanic level of complication, put software, comes better. So we like that. And we apply best practices in Silicon Valley, hopefully backing world-class founders. It's either that or businesses that from day one want to be global. We love investing in foreigners. We're all foreigners. I've had 3 visas, 2 waivers. I've been kicked out of the US one, so I filed an appeal against the federal government to be able to come back. Today I have a green card, but and this is absolutely apolitical. I really don't care about the federal government in that sense, but I love investing in foreign founders because they're more resilient, they have a chip on their shoulder, they gotta prove something. So from day one, there are 2 companies we've invested, one called Pipefy, recently raised a $16 million Series A with Trinity Ventures and OpenView Ventures. They have 120 people in Curitiba. That's like a tier 2 city in Brazil. Tier 2 not in the sense that it's worse, it's just smaller. It's like Austin. And they have 16 people in San Francisco. Or Gympass. It's a company that will certainly go public, raise over $63 million with the latest round from General Atlantic. So we don't want to do the local version of X, Y, and Z that's already happening out there, kind of like the old rocket model, right?
Yeah.
Not a criticism on them, I think that they're great. But either ultra complicated local things or things that from day one you're ambitious enough to be global. problem with emerging markets that are big is that, it's not Israel. If you're born in Israel, you're fucked. You have to have basically a wall of missiles in order not to die. So you're born more, you got to go to the army, right? So there's that book, Startup Nation. Like, so people are just wired in a different way. That's why Israeli founders usually are bad at enterprise sales, because they're just too impatient. But other than that, they build great companies. So we want people that think about, first day global aggressive as well. So.
That's a very interesting thesis. And how about, we've been talking a little bit about venture capital, but I'm curious about your point of view of, the corporate venture investing versus venture getting, funded by a venture capital. What's your point of view on these two different, sources of capital for a startup?
So my point of view is that corporate venture is that you can. I've observed, because I've never taken it, and you may be able to speak more effectively to this, that it's a lot more limiting to take corporate strategic venture capital. You end up having to align with the person whose capital you took and all of that other sort of stuff. Whereas private just pure VC capital is really sort of inspires entrepreneurs to get to the best part that the company can be the fastest, and the solutions tend to be observably better. That's just a really general high-level point of view. But I mean, you may, as a VC, and that I don't know much about you. So you're a partner at a firm right now. Yes?
I started the firm.
Yes.
Yes.
I just want to be clear. So, I mean, you obviously prefer what you're doing and what do you think about corporate venture?
Yes. So basically, if you look back in the last 15 years of VC, corporate venture capital has represented about 25% of all dollars deployed.
Right.
And it has been steady. It kind of it doesn't really grow that much because it's hard. There aren't that many corporates that have a long-lasting corporate practice, right? You have Intel, Google, Qualcomm. They're like probably Microsoft, Salesforce, SAP. There are a few things that I think are great and can be extremely helpful whenever you raise money from corporate, but there are other things that I think could be disastrous for companies.
Right.
So I'm not anti any of that because there is room for strategic financings and even, not to continue to talk about Rappi, but they raised their Series B from Delivery Hero and NADEAU, and they had term sheets from all the tier 1 VC firms in Silicon Valley, and they decided to do that because Delivery Hero was in a position to add a strategic level of help that no other VC could do it.
Were they interested in bringing them in as a supplier? This company, who was the company?
Delivery Hero, it's a similar...
I know Delivery Hero, but the company that they...
Rappi.
Rappi?
They invested in Rappi. They led the Series B.
Okay.
And the Series C then was done by DST, so regular VC.
What was the alignment?
The alignment was to get a board seat and also help operationally, because they were doing the same thing that they were doing, but in 5-6 times markets, like more, just like they've solved many problems that they were now suffering and could then connect the same people. Mm-hmm. The problem that happens is that basically, in general, 90% of the time, a pure VC will be aligned with you long term, because everyone wants to have that success. What could happen when you raise money from corporates, depending on how you structure the deal, is that alignment could be there today, but it could not be, maybe it changes in 3-4 years, because whatever, the market changed, the view of the business changes, and you don't want to have dead weight on your cap table or even people that potentially could compete against you. So my encouragement when companies are raising money from corporates is, number one, have they been doing this for a while? Okay. And basically, never trust other VCs. The best way to understand if a VC is good is talk to founders that they've backed. It's the fastest way. And founders will always be willing to jump on the phone, good or bad experiences, right? The other point is really, and this is a little trickier, but I think that if you're meeting with a corporate VC, you want to be that founder that at the right time in the meeting asks the question about, like, how is it that you're compensated? Because sometimes, they're investing straight up from the balance sheet versus having a straight up fund structure. And we raise money from family offices and billionaires and corporates and institutions, and we have a fiduciary responsibility to deliver those returns. So otherwise, we're not going to be in business. So it doesn't matter all the glory stories and the beautiful things about innovation. We're a financial product at the end of the day. And if we don't return money to our LPs, we're done. Sometimes that is not the case for corporates. So you got to really understand the compensation. Like there's that quote from Charlie Munger, which is like, you want to understand superpowers, understand alignment of interest, and you got to understand how is it these people are getting compensated. And then it varies a lot, I've seen. I've seen corporates that have traditional fund structures where they actually are compensated through the fees, and it's a completely separate thing. And then you've seen other ones that just invest through the balance sheet, but they have this back of the envelope IRR calculation for the returns where, they get paid cash bonuses by markup. Like, so you see everything. And the problem though is kind of like when you raise money from a VC, I hope, right, that this is going to be the last job of my life. We're going to continue to scale the firm and raise more funds, and this is it. If you're dealing with someone that's working at a corporation, maybe they have a board seat, they have your partner, and then that person leaves, what happens, right? I don't think it's all that bad, because sometimes strategic partners can play a huge differentiated role into what you're doing. But sometimes they could eliminate competition, or they could bring several misalignments. So they are an important part of the ecosystem, and we enjoy working with corporates, but we are always very, very disciplined to find long-term alignment when we partner with them.
Obviously, I think that's really important. And there are some cases where we were talking this morning about companies like, I don't know if you're familiar with Corner Shop from Chile, that they just got acquired by
Walmart.
Walmart. Yeah, one of their first acquisitions in Latin America. So I think it's something really special. It's happening when it comes to, corporations and startups, especially in these emerging markets. So we have just a few more minutes. Do you have any word of advice? I'm sure that we have some entrepreneurs in the audience or some executives from corporations. Do you have any word of advice for them in terms of how to get the right funding, or if they're thinking on having their corporations investing in startups, what would be your word of advice for them?
Well, for me, I think it's, if you're looking for international capital, I think you have to, first, obviously, check in with your local investing community and get started there, but you have to go into these markets and meet these people, whether it's through events or like just showing up at their offices or whatever, because that's where you really understand what VCs and investors outside of the country are looking for. Just get on a plane. I think that's probably the best advice that I have. I don't know about you in terms of international capital.
Sorry, the question was if I'm looking for international capital?
Yeah, no, just in
as a
general
founder?
for the audience, what would be your last piece of advice for them in terms of they want to get international funding, they want to go big? You were talking about, thinking globally.
Yeah, well, work on a massive addressable market, speak glorious English, build something that people want, and then find ways to have external validation badges that would then work well with the emotional confirmation biases of whoever is sitting next to the table to you. That could mean getting an MBA from Stanford, going to YC, could mean have great traction. It doesn't mean aggressively pursuing them or writing long emails, right? Like, what is important to understand is that there's that, I think it's from Abraham Lincoln, that quote that's like, if I want to cut that tree, I'll spend 2/3 of the time sharpening the axe. So getting ready and deeply researching and understanding these people and then going after them is more important than just running like crazy and not preparing yourself. The easiest way for you to soft land at an international market, in my opinion, is to go through a program like Techstars or 500 Startups or Alchemist or YC, because it helps you build the right relationships with your peers, puts you in front of investors in a systematic way, and hopefully will teach you new things that you haven't learned before. And I think that for us that live in the Bay Area, it's very simple. Like there's an etiquette in Silicon Valley. And sometimes I see international founders that just don't understand that thing that is already so ingrained in the culture. But if they spend 4 or 5 months there, they get it. So, you maybe all you say like, look, I don't understand any of this advice, but I'm going to learn English on my own, and I'm not going to go to any of these schools or not even get into an accelerator. You can just take the kamikaze approach as well, and go and get a desk at a co-working. Like I've seen people do this as well. I thought it was cool.
Were they successful?
No, they were successful. They were able to raise money, yeah. But they were working at different co-working spaces every month in San Francisco, and then networking like crazy. And then it worked out well.
Interesting.
Yeah.
Well, just in this last minute, any questions from the audience from these two investors?
I'm not an investor.
Not an investor, but an investor and an expert on investment. Any questions? No? Well, thank you so much. And
Thank you.
Yeah, we look forward to seeing through TECHCRUNCH what is happening in the investment world in Latin America, China, and the US. So thank you so much.